Brian, I think we'll begin. Welcome, everybody. Thanks for being with us for the AMR quarterly economic and market update. As you may know, we tend to have two webinars each quarter, typically. One of them at the start of each quarter is about the markets and the economy, and we often will have a either webinar or seminar on financial planning affairs. So we'll give you some information about that toward the back end of our program today as to what's coming up next. Want to just remind everyone with a little bit of compliance reminders that opinions are subject to change and information has been derived from sources thought to be reliable. Our content is informational and not intended to be specific advice to you and without talking to you about your own specific circumstances. So be sure to speak with us or your financial, legal, or tax advisor about what strategies make sense for your own circumstances. We have a detailed disclosure at the end of the presentation, and hopefully you'll have a moment to review those. We will have a period for questions at the end of the presentation if people want to ask questions. In the meantime, throughout the program, you're welcome to use the Q&A button or the chat feature, and we'll be happy to keep an eye on those, and if appropriate, try to address those curiosities during the content of the presentation. Our presentation is being recorded, so continued participation implies consent. This webinar will be posted on our website and our YouTube channel later today. And in fast-changing times, keep in mind that we encourage our clients to listen to our radio show podcast for our most current thinking on the portfolios and related topics. So with that, let's get started. Joining me today is Brian Regan, our firm's Chief Investment Officer. Brian, I'll let you take it from here.
Great, thanks, Chris. A quick agenda. I'm gonna touch on topics. Things are not as they seem, but we do have a deteriorating economy. The economy is not the stock market. Deteriorating economy is definitely bad for credit. We're going to have some Q2 takeaways, and then we're going to have a couple items that we think are important to talk about lately. First, with higher rates, maybe some political reasons to be concerned about things in the near term. People might want to consider their options for as very conservative investors. And then we do have an individual stock portfolio. Over the years, we've been very happy with how it's done, and we want to give you an update on what some of the things that we've been doing in that portfolio. So things are not as they seem. This is a picture of the city of Boston, where I live, and these are palm trees. This is not the natural order of things, and I think we all kind of understand that. That's really the theme of today's presentation. I think there is a perception of a lot of things that are not the reality, and certainly the first few slides are going to be definitely about that. So first, Americans are confused about the state of inflation. This looks like 87% of Americans think that interest rates are either going to go up a lot or stay the same. The reality is that, sorry, that was inflation. 87% of Americans believe that inflation is going to continue to be a problem. The reality is that inflation has been going down since June pretty significantly. So, we hit that high watermark around 9% in June. We're down at 5% today in the CPI. If you were to do a 7-month run rate, you're looking at 3.7%. If you were to adjust for things like rents, you're looking at something like under a shade under 3%. So inflation is not the problem that it used to be, despite that Gallup poll that we saw, where it seems like they're definitely concerned about that. Americans are confused about the state of interest rates. So as I misspoke before, there's a big number of Americans that are concerned that interest rates are going to either go up a lot or stay the same. this isn't necessarily the truth across the yield curve. So it is true that the Fed funds has gone up significantly over the last year, 16 months, 16, 17 months. And it's actually expected to go up even further. If you look at the 3-month treasury rate, for example, which would take into account the next Fed raise, we're looking at around 5.1, 5.2% on the 3-month treasury bill. If you look at that 10-year treasury rate, though, this is a little higher today. From when I pulled this is 3.35%, and you can see that it's clearly steadily kind of stagnated since October. This has been good for stocks, but I just want to make the point that, yes, Fed funds has been going up, but that doesn't necessarily mean that all interest rates are going up. And when you think about interest rates, Fed funds is actually probably the least important one. If you would think about mortgages, for example, the price really off the 5-year treasury rate. If you think about, corporate borrowing, it's more like the 10-year. The stock market goes up about 80% of the time. It normally does very well. So you would think that market sentiment would be typically pretty good. So this is the percentage of U.S. investors that are bullish. 22.5%. It's a very low number. You can see even more recently it was even lower than that. This is just not accurate for what we've actually seen in the stock market since October. So as those rates have stagnated and fallen some from its high, the 10-year rate, we've actually seen the S&P 500 rally about 12%. So that's been a very good 6 months, no matter how you look at it, despite extreme negative sentiment. Now, I do think there are some good reasons on why we're having, the negative sentiment, the idea that inflation's continually bad and that interest rates are going to continue to go up, even though they're not necessarily true. We do have a deteriorating economy. The economy is still strong. Q1 GDP is expected to be solidly positive, anywhere between 1% and 3%, depending on where you look. But we are seeing some cracks in the labor market. The labor market is still very strong historically, no matter how you measure it. But the lines are starting to trend in a different direction, where we're starting to see some deterioration. This is not to mention that we've had bank failure. So, this brings back memories of the great financial crisis for sure. Signature Bank, Silicon Valley Bank, and Credit Suisse all went under in the last month. This was big news, no doubt about it. And what is the biggest effect about that? Well, we've seen lending standards tighten dramatically. These charts show it in every developed country except for China. We've had some big changes in the lending standards. Not surprising, even though that we were able to stem the worst so far of the banking crisis through some smart moves by the Federal Reserve, some smart moves by the FDIC, even some smart moves by the Federal Home Loan Bank. There's no doubt that lending standards are going to get tighter. And the issue with this is the lifeblood of the economy. Many businesses need to refinance. Many businesses need near-term credit to fund their operations. So tightening credit will likely lead to more defaults in a slowing economy. And those things will also lead to more layoffs, which is what we're seeing here. So we're seeing continuing claims for unemployment insurance tick up. This is only a 1-year chart. If I were to back this up many years, you would see that those continuing claims are still very, very low based on historic standards. This does not mean we're in a recession, but that line is clearly trending in the wrong direction. Same thing for initial claims. Initial claims is more indicative of people who are getting laid off in the near term. Continuing insurance is more indicative of people who have struggled to find a job. And then on top of that, it was well known that U.S. job openings were around 11.5 million, very, very, very high. I mean, it was like 2 jobs for every 0.8 people that were looking for a job. That's fallen, almost 15 to 20%. Now we're looking at 9.9 million. So that we're just seeing some small cracks in the economy. The economy is not the stock market. So, does a recession mean that things are going to be bad? Well, this chart from JP Morgan would say no. And the reality is that the stock market tends to anticipate declines in GDP and declines in earnings well ahead of those things actually troughing. And we had a dramatic sell-off in 2022, obviously. In 2022, NASDAQ was down 30%, S&P 500 was down 20%, even bonds were down 16%. So it was a tough year, but like I showed, the S&P 500 has actually rallied 12% since the October low. And that could be the case that they anticipated the low, priced it in, and now we're seeing the stock market return as the market anticipates continued earnings. So, to the point on earnings expectations are not bad. People seem to think that these expectations are going to come in. They have come in. They were at $240 a share in the S&P 500 for the next 12 months. Now they're at $230 per share for the next 12 months. And the reality is, I do my own calculations and I put in, hey, look, what happens if it's $210 a share and the economy in the S&P 500 only grows earnings at 3.5% a year in perpetuity, which is extremely conservative considering that we typically grow at 9%. And I assume, a 3.6% 10-year treasury. And then somewhere between 3,800 and 4,100 is fair value. And when the 10-year treasury was at 340, it was around 4,000 to 4,200. This is all to say that even if you take conservative estimates, the market's not expensive. And if we assume the 9% growth normally, we can expect things to be even better. So this is just a visual way of saying what I just said, mathematically. The market's not expensive. Certainly, historically, it was expensive, in 2020. We've had a dramatic correction since then. Now it's around the long-term mean. I would expect, this long-term mean to continue to tick up as we have seen it do, as it starts to take into account the economy of the bits and bytes economy and starts to discount the bricks and mortar economy that we were in prior to the internet age. So what have we seen over the last 6 months? The 10-year goes down, the NASDAQ goes up. The NASDAQ's had a very nice rally over the last 6 months. And, we've seen this negative correlation between the NASDAQ and the 10-year treasury, which has helped to buoy stocks. So as the interest rate has come down, the NASDAQ has done well. That relationship is not as strong today as it was maybe a couple months ago. And this is now the market anticipating that the 10-year is at more or less a fair value, and that earnings are going to be more important in the future rather than interest rates. It's still very important though, so I don't want to say that we're not concentrated on interest rates anymore. I still think that's going to be the driver of stock market returns. So a bad economy is bad for credit. So here's Boston on a beautiful spring day. This is more appropriate from what we would expect outside today in April, rather than that palm tree scene that we saw at the beginning. So we did make a mid-quarter adjustment. We were, since July, we were fairly heavily into high yield bonds, and high yield bonds have done well for us. But during the banking crisis, we expected tighter lending standards, more defaults, and that is generally bad for high yield. So you can see that red arrow that I put in there. That is the uptick in spreads that we're trying to get ahead of. It's since rallied a little bit from there, but I don't think this is going to be necessarily great for the time being. Now, that doesn't necessarily mean that it won't be great, in the longer term. Just as a quick refresher, as these lines go up, the bonds actually sell off, and that's a bad thing. So we want the lines to go down. The lines are relatively low now based on historical standards, but the volatility in this market has given us great opportunities over the years. And when I look at, the 5-year history of us going in and out of high yield, it's been one of the best drivers of our bond returns. Obviously it hasn't been a great 5 years for the aggregate bond index, but our positioning in high yield has served us very well and has led us to add a lot of value. So yeah, we're out of it for now. There's not a good risk reward in it, but I think it's not goodbye, it's see you later. So let's talk about yield curve positioning. So we're moving on from high yield bonds, talking more about our investment grade bond portfolio. Generally speaking, we want to target the quote unquote fat part of the curve. So the fat part of the curve is the really the steepest part of the curve, right? It's the part of the yield curve where you're getting the most return, the most yield for the least amount of incremental risk. So you can see that yellow line represents 1 year ago. We have this natural kind of upward sloping curve. It's a little bit inverted between the 3-year and the 10-year. But generally speaking, it's a yield curve that we would expect to see. We were very short in duration then. Normally you'd want to be, the fat part of the curve is between 3 and 5 years, or even 4 to 7 years. So we were short a year ago. We had this fund USSBX. It was a USAA fund. It did well for us. It served us well. We outperformed the aggregate index by a good margin by prioritizing that fund. About 6 months ago, the yield curve migrated a little bit, and we added JPST to the portfolio. And even further, it's migrated even more. And now JPST is a big part of our portfolio. So JPST is cash-like, it's a little bit more aggressive than a money market fund. It targets under 6 months in duration, and right now that's where we're getting paid. So, we're getting 5+% from this fund. 5.1% right now is a 3-month T-bill. So probably even better than that.
And just to be clear, that's the gross yield, not net of fees.
Right. It's an estimated yield to maturity for that fund. So, that's a great thing. We're going to get paid with not a lot of interest rate risk. The bad thing is this isn't expected to last a long time. So, we're going to benefit from this while we can. But this isn't likely to last. The market, when it has a inverted yield curve like this, is basically telling you that in short order, the Federal Reserve is going to have to change course and do the exact opposite. But for now, we'll take this nice yield at minimal risk and be happy about it. So inflation drives yield, and yield drives stocks. So this is basically the same chart I showed you before. This is NASDAQ 100 total return in the 10-year Treasury. So we can see again the negative correlation. This one's a little bit more updated. And again, we're saying that the yields on these are going to fall with inflation. They're expected to fall, especially the short end, and that should continue to buoy stocks. I think this story was, very true 6 months ago, as the yields were a little bit higher on the longer end of the curve. They've come in some, but in more recent days, we've actually seen it pick up. So this could play out. There's a very extremely volatile yield market. We saw it sell off during the bank crisis, and now that the banking crisis has kind of settled a little bit, we've seen yields tick back up. But that doesn't mean that they couldn't settle back in longer term. We would expect yields to reflect about 1 to 1.5% greater than long-term inflation expectations. Long-term inflation expectations are about 2.3%. If you add 1%, that's 3.3%. If you add 1.5%, that's 3.8%. We're at 3.6% today, maybe a little bit lower as of this morning. That seems like a reasonable, guidepost. If it were to fall, that's going to be good for stocks. If it would go up to 3.8%, that'd probably be bad for stocks. So a bad economy leads to falling inflation expectations. Like I said before, inflation expectations is what's going to drive those yields, and that's going to drive stocks. We're very concentrated on what the interest rates are going to do, both from the fixed income perspective, but also from the equity perspective. We are very short in duration on our fixed income portfolio, so that means we can actually be a little bit longer duration on our equity portfolio, and that's what we're doing. So as the 10-year comes down, it says 3.43 here. The prior chart was a little bit more dated. We're going to expect that the longer term, more aggressive stocks in your portfolio are going to do better. Now, what are the takeaways? There is unwarranted pessimism in the market right now, given the recent returns, interest rate, and market moves. The pessimism for the economy is warranted, but the economy is not the same as the markets. This is a very important point. The stock market historically recovers before recessions and before earnings trough. Earnings expectations are still not that bad. $230 a share is good. And, we're only 8 months away from 2024. And in 2024, earnings expectations are north of 240. they're not expected to go down in 2024. They're expected to go up. So until I see some significant deterioration there, it's hard to get really pessimistic. And as time goes by, it should just make the average investor more optimistic. Right now, we're being the tail of the dog is being wagged by interest rates, which is why I try to spend so much time on that. But when the interest rates start to be steady as they have been historically again, the dog's gonna be wagged by earnings. So it's still something to definitely keep an eye on. Bad economy is bad for credit. So we made the mid-quarter adjustment. Regular listeners to us, regular clients will know that we don't like to make mid-quarter adjustments. We do so if we think it's really warranted. I think we've done 3 or 4 since I've been at AMR. So maybe on average, 0.75 mid-quarter adjustment moves a year. It's something that we don't, once we make a thesis and an asset allocation, when we like to see the data play out for at least 3 months typically. This was, a banking issue is a big enough problem where we wanted to take some risk off. We did that. We don't expect to have to make any significant moves, going forward, because we already made them about a month ago because of that. Aside from the 60/40 Core Explorer, you should expect to see some normal moves in there. If you have that, we will be, investing excess cash. The stock market has done well, so I won't rebalance that. We started the quarter, underweight stock. Now we're still going to be underweight stock, but a little less underweight stock. We still have a pretty conservative portfolio. We're being very conservative on the bond side, but we're getting paid more. We're being conservative on the stock side because we're underweight beta, we're underweight stock. We're prioritizing higher quality positions. Like we don't have any small caps because that's also bad for credit. We're very balanced right now. We're not really leaning one side or the other in any crazy way. That's where we are right now. We don't think there's huge opportunities. We think the market can move either way on any given day. It's over the longer term, we're fairly optimistic, partly because we're getting, higher interest rates, but partly because we think that the stock market's fairly priced, and fairly priced stock markets are going to give you 5 to 10% over time. That's no comment on what we expect over the next 3 months or 6 months, because quite frankly, most people don't know how the stock market's going to move in any 3-month period. So, given that, again, finally, inflation expectations are down, the 10-year treasury is down, and the NASDAQ's up. That's been the story of the last 6 months. Hopefully that continues for us, because that means that we'll continue to do well. I mean, most of our, or not more, I'd say all our client portfolios that are on a discretionary basis have done very well over the last 3 to 6 months. So, we did talk about how interest rates are higher, how it's very beneficial right now to be short on the yield curve. And for that reason, Chris has been the biggest cheerleader for this. He wants to make sure that everybody knows that there are very conservative options right now for investors that want to take that route. And we want to lay them all out for everybody, so they know that, there are a wide variety of offerings out there. And if we constantly tell people, you should reassess your risk. And if you reassess your risk right now and you're not feeling good, you're having trouble sleeping at night, definitely pay attention to the next few slides. I think you'll find an option that, might work for you.
Well, thanks, Brian. I think I want to just reiterate some of your comments that, recession worries are very different from market movements. And there are a lot of things that I think very conservative investors might be paying attention to and being concerned about. We had a very good year this quarter, almost, but it's following the declines of 2022. So it's somewhat of a rebound. But if you're thinking that you want to be very cautious, we're in a very different world than we were just a year ago. So for very conservative investors, it's worth reviewing what are some of these different approaches. And, I've heard from people, who are talking about things like, well, it's getting to that time of year where, you sell in May and go away, or what's going to happen with these antics in Washington, D.C. surrounding the debt ceiling, or who knows what, geopolitical events might unfold. There's always something that can be a driver for anxiety. And for those investors that are most sensitive to volatility, we want to just review what are some of the possibilities. Over the last decade or two, well, not quite, but over the last decade or more, it's been a very low interest rate environment, and it's been challenging for people looking for more stable options. So in the midst of that experience, we created our preservation strategy. And Brian, you can move to that slide for a second. Our preservation strategy is really designed with a target of around 30% stock exposure, and the rest is invested in various bonds positions. It's done with mutual funds and ETFs. And this, we've historically said to people that it seemed reasonable to expect, 3 to 5% from a strategy like this. Of course, markets have moved, interest rates are higher. So who knows how that may be altered over time. But it is a reality that, and we've had better returns at times. And of course, this illustration here is showing even last year when markets went down, it did have disruption. So a strategy like this is more prone to some volatility concerns, but it also has, of the options we're going to discuss, probably the highest possible performance opportunity as well. Remember as well that with our strategies, we take an active approach. So there are times when we might have it actually at 30% equity. There might be times when we have it closer to 25% equity, and other times a little bit overstated, 35% or so. So these are levers we can change. It doesn't have to be purely the actual allocation of stock. It can be what we hold within the bonds, what we hold within the stocks that can enhance returns or affect the risk. Brian, anything to add to that comment before I move on?
No, I would just emphasize that this is the one with the most volatility, but also the most return. If you're looking at this chart and you're saying, hey, look, 4% return over 3 years, that's less than what, we're getting in cash. That's true today. That might not be true tomorrow, if the Fed has to cut rates. And it definitely wasn't true over the last 3 years because the cash rate was near zero. So this is definitely outperformed cash. We expect it to continue to outperform cash, but it is also the most volatile of the options.
So if you can tolerate a little volatility, we think you'll get the best returns here. Now, not everyone is as comfortable with some volatility. So as we go through these options, they become increasingly less prone to volatility concerns. So I think would be generally the case. So another way to go would be to have no stock exposure per se, but to have a mix of various kinds of bonds. And some of those bonds can have some risk, but we think that this kind of an approach is likely to be an attractive way in an environment where yields are now paying more from your different kinds of bonds and high quality bonds. We can have a mix of the short and intermediate term. We can include some high yield bonds in most instances. So this might have a modest amount of volatility, less so than the 30-70. Generally, we'd expect a little less return than the 30-70, but more stability as a consequence. And again, this is something that we control, making the decisions about how to position this portfolio with the mix of the bonds that we might select in the mix. So again, we're using funds in the way we compose this portfolio. Brian, anything to add?
Yeah, the other thing I would add is I want to emphasize the high quality nature of this portfolio. we have had in the past high yield, which has actually helped the portfolio. It's no longer in there right now. It's just for the same reasons why I mentioned in the
What we
asset
just talked about.
portion. So if you look at the bond credit quality exposure there, it's very good. I think it's, would be a valid concern of many people if they said, hey, look, fixed income got crushed last year, and it did. There's no doubt about it. But the fact is that makes this more attractive going forward. The comment that past returns are,
Not indicative of
not indicative
future.
of future returns. It's very true here. There it's more of a warning. Here, I think it's a good thing, right? The past is over, and going forward, I would expect
Yeah,
this to be
yields
fairly
are higher, so that should help. And that, you mentioned about the high yield exposure being, less an issue today in our mix, but that's subject to change as we make adjustments but overall, it is fair to say that this portfolio will be expected to consistently have higher quality investments as the core of its structure.
Yep.
We found that in these times that sometimes people would benefit from just having a combination of some short-term bond exposure. So whether you indicated a couple of examples of that prior in the program, but whether it's very short-term corporate bonds, or in some cases we've used short-term treasury bills as a way to provide this, it's an opportunity for people to have very modest risk with some decent yields today. It is more volatile than a money market experience would be. That's not absolute stability, but the yields are attractive, and it can be a way to have a little bit of low risk kind of orientation, but get a little bit of return off of this, maybe a little more than we might expect from a money market by comparison. By doing this, when rates rise, we have the opportunity to benefit more rapidly. On the other hand, should the idea of rates change direction, this may have less appeal at that time. Any additional comment?
Yeah, for compliance reasons, I'm not allowed to show the actual assets that we would buy here, which is very frustrating to me. And hoping that we can work that out in time. So I'm just showing the 3-month treasury rate here. This isn't a total return rate. This is the rate that you can get at any given time for the next 3 months annualized, right? So right now, if rates stay where they are for the next 12 months, you would be able to get 5.2% on a 3-month treasury rate. That is gross of fees. That is not expected to last. The market is pricing in that won't last, going into 2024. But right now, it's a nice opportunity where, at least in the short term, you can expect to get a nice, payment every month from the ETFs that we would get into until that changes. Now, I highlighted the summer yield there, just to see that not too long ago, the yield was much, much lower. So I'm just trying to say that this might not last.
But it's also important to make the point that it's a different world than it was a year ago, or not even a year ago in that example.
Yeah, certainly. It's definitely a different world than it was 3 years ago. As you can see, the rate was near zero. So this is kind of a unique opportunity. It may not last, but there are certain benefits of not a lot of volatility and a nice payment. Now on the next chart, on the next slide, is on money markets, and I need to say that same reason for compliance, I couldn't use the actual money market chart, but this chart shows some volatility. There would be zero volatility in a money market fund, and I'm just not allowed.
Yeah, so let's just talk about what that is. Again, to remind, it's been a while since we've talked about money market funds as a tool that, over the last decade, we've opted to use with cash. We've used an FDIC insured account because in either instance, we weren't getting compensated for, where we were holding our cash. Today you are. And so for investors who have money sitting idle, it's worth talking about what's the best place for this? And it may be worth reviewing what is a money market mutual fund. And effectively, it's something that invests in a combination perhaps of treasuries and short-term commercial paper, very short-term money being lended to corporations that are of high quality. So the idea is that a dollar in is a dollar out. You don't have to worry about fluctuation in price, but the yield will fluctuate over time. And you might think of it and trying to think about what's happening with the Fed funds rate as an indication of the direction of how this is going to move on the money market funds. So, as you mentioned earlier, these rates have gotten much more attractive, and it may be worth examining where you're holding cash. Now, in our case, most of our strategies don't really hold more than something on the order of 3% in cash. And although your Morningstar view, as you look at, say, a Morningstar style, it'll appear a pie chart of your asset allocation. It'll appear to have a lot more cash, but that's really because we have very short-term bonds that Morningstar classifies almost as if it's cash. But in any case, money in a money market mutual fund is stable. It has a decent yield today that it didn't have a year ago, and it can have some appeal for people who are looking for a place for stability and access, liquidity. It's entirely accessible. So the least of the risk probably options we've discussed so far. The last of these I wanted to just point out, this may not be the least risk, but when interest rates have moved, you can entertain looking at alternatives like treasuries or CDs. We've heard people talking about CD rates more. We had a gentleman recently who we discussed the idea. He was contemplating just going to get a CD that could get him a decent rate. And, we wanted to point out to investors that, you can get a CD or CD ladder through your brokerage platform. And oftentimes these are probably paying a little bit more than you might get through your local bank. And it really depends on the bank and so forth. These are FDIC insured when they're CD. If it's a treasury, of course, it's the backing of the US government. So rates are not as good as they were as maybe a couple weeks ago, a month ago, but they're still very attractive. Again, this illustration, the rates change from day to day. This is gross of fees, not net of fees. So, it becomes very relevant to say, well, what can I get for my alternatives? And, talk to us if you're a client dealing with us, thinking about these issues. We can help you navigate which is a better place to be. And it may very well be that you get a good rate at the local bank, and that may be very attractive. On the other hand, it may be that we can help you find something that can give you high quality options. When it comes to CDs or treasuries, there are differences in liquidity. And even though a CD, for example, might be FDIC insured, and if I hold it to maturity, I know what I'm in for, it will change in value from day to day on the market, what someone's willing to buy that for. So, you have to be mindful of how are you going to approach it. Most people, we think, in this kind of an approach are intending to buy and hold to maturity and then just replace it if they don't need the liquidity to buy it back into the ladder. But if you did need to sell, it is relevant to know that, prices will change from day to day. Anything to add, Brian?
Yeah, I just want to add that if you do have to sell these, if you do need the cash, you will take a loss on them, likely because of the liquidity. You could take a gain on it possibly too if rates fall, but you're not gonna get par out like you would with a money market fund. And I think that's a huge difference.
Yeah, or if you did the CD ladder at your bank, but you'd pay a charge to get it out of the bank prior to maturity as well. So it's a slightly different approach.
So I do want to
Okay.
talk about the individual stock.
If I may, just before you do, let me just mention as a concluding comment, if you're a conservative investor thinking about, do I have the right mix? I just wanted to bring all that up to say there are options and there are things that you may want to evaluate because it's a different moment in time than it was just a year ago when it comes to where the rates are. Yes, interest rates are higher for other types of investments when it comes to, say, for example, CDs or whatever, but they're also, yields are higher on the investments that you're in when it comes to the bond composition as well. So get a complete picture before making any revisions. Okay, thanks, Brian.
Okay, so I do want to talk about the individual stock portfolio. Normally, when we do these quarterly webinars, we mostly are talking about folks that are in the ETF mutual fund structure because most all of our clients are in that structure. But we do have some clients that have some, rather big portfolios that, we manage on an individual stock basis. Again, we're very proud of how these have done. So if you're, interested in hearing more about the philosophy of how we do it, I'd be happy to talk to you. So let's talk about the top holdings. I can't, there's 33 holdings in this portfolio. I'm not going to get into detail about all of them, but, let's talk about the, what's really important here. We own quite a bit of semiconductor exposure. We own Applied Materials, AMD, and Micron. These are all different kinds of semiconductor companies. Micron manufactures and designs basically memory chips and RAM chips. AMD does kind of next generation logic chips. They also do serve a variety of different end markets, which is very attractive to us. And Applied Materials, they do the capital equipment manufacturing. So the actual fabs that build a semiconductor, they make the equipment for it. Applied Materials is one of our biggest holdings and will continue to be one of our biggest holdings because there is going to be a big onshoring of semiconductor manufacturing, and they are, one of the cream of the crop for that particular part of the sector. Interestingly enough, AutoZone and Microsoft. Why do we own AutoZone? AutoZone has just been an amazingly consistent retailer, and when it comes to retailers, we want consistency. And this started out as a relatively small holding for us, and without buying more, it has just grown into being a bigger holding. And to me, that's the perfect kind of holding. Microsoft, a little bit more of an adventure there. In the last 6 months, we've gotten more heavily invested into it, partly because we had an Oracle position that did well, but we thought it was getting a little expensive. They were buying back a lot of stock. It didn't look like they're going to be able to continue to do that, especially given the fact that they are making some acquisitions. So we used the nice price that we were getting in Microsoft and the expensive price that we were getting in Oracle to make that trade. You can see a little bit more in detail here. I talked about the semiconductor stocks. They've done very well. They've outperformed the total stock market, which has helped these stocks grow into a bigger part of our portfolio. AMD, we ended up with AMD because we bought a company called Xilinx, and then AMD bought Xilinx to diversify their portfolio. So that became, an even bigger part. They're sitting on some nice gains. They've done well. And we've also done, you can see that dip there that happened in, the summer of last year. And we used that as an opportunity to buy more of some of these stocks like AMD and Applied Materials and Micron. So I talked a little bit about Microsoft, and here's a chart of, Oracle and Microsoft, and you can see that, there's a big gap there. And as Oracle started to rise and Microsoft started to fall, we found that as an opportunity to make a trade to bolster our case for Microsoft and sell off our Oracle position. Oracle has continued to do well. The stock is quote unquote breaking out right now, and I wish it the best. But I think a lot of the reason why we liked it was because of the excessive buyback that I don't think is going to be able to continue. So here are some recent changes. We own Target. We bought Target during the pandemic, a very attractive price. We did well in it, but we've moved over to Tractor Supply Company, and really for two reasons. Target is more discretionary oriented. I understand that they sell groceries, but it's not a big part of their business. And Tractor Supply Company is more staple oriented. They sell pet food and livestock food, for example, as part of a big part of the business. They have a discretionary business as well. They've been more consistent over the years. They have more room to grow. It's a smaller company. It's about, $20 billion company, $20 to $30 billion company. So it has more room to grow. It's more consistent. I think it's better positioned for the type of economy that we're heading into, which is going to prioritize staples over discretionary type products. We sold some Broadcom. So I mentioned before that we're heavily into the semiconductor industry. Broadcom is a big semiconductor company. The biggest customer is Apple. They sell a lot of chips into the iPhones that we all use and love. But we also have an Apple position, and we also have a Berkshire Hathaway position. So Berkshire Hathaway owns a large swath of Apple. So you start to look at your portfolio and say, hey, look, where am I overly exposed to one company, in this case, Apple? And I thought we could sell some Broadcom, and we bought Cheniere Energy. Why do we like Cheniere Energy? Well, Cheniere is the biggest exporter of liquefied natural gas in the United States. I think we are all too familiar with the need for liquefied natural gas globally right now. And most importantly, I'm not concerned about short-term fluctuations with this company and the price of natural gas, because they have 20-year contracts, which get a spread over the index, and they also hedge the index. So there's no, what I'm getting paid is that spread. I'm not getting paid the change in the underlying commodity. So there was a lot to like in Broadcom. We still own Broadcom. We just own less of it. And there's a lot to like in Cheniere Energy for the longer term. Finally, we went through a whole lot of stuff here today, Chris. I'm very curious if there's any questions. Chris, I can't hear you. I don't know if I'm the only one.
Thank you. Sorry, I'd muted my line. If you'd like to ask a question, there's plenty of things we've talked about that you may want to backtrack on. We'd welcome your questions. You're welcome to do that by either using the Q&A button or the chat feature. Or if you'd like to ask your question verbally, you can use the raise hand feature. Any of those will get our attention, and we'll be happy to address that. So Brian, while you're talking about the stock portfolio, two things. Maybe you can just advance to the next slide, and would you also maybe characterize for people? We don't talk about the individual stock portfolio for everyone. Who do you think should be tuned into the stock strategy as compared to when we recommend an ETF mutual fund strategy?
Yeah, so the stock strategy is going to be more volatile, right? It's more risky. There's only about 30 to 35 positions in it at any given time, sometimes even less. The positions we make are definitely going to be out of step with whatever you're seeing on the TV. A good example of this is when oil was negative. That's when we found the opportunity to buy oil stocks. When oil stocks became in favor, that's when we became net sellers. So it might seem like we're uncharacteristic to buy something that is literally selling at a negative price. But we want to buy it because we think in the longer term that wasn't going to last. We thought, we'd get paid for it eventually. Lots of good things to like about these businesses. We understand that they're cyclical. So, we want to buy it. And then at the same time, you might question, why am I selling it? Well, because, I'd rather be buying stuff in a cyclical trough. These things can reverse very quickly, as we have seen with oil and gas. It was kind of entertaining to me a couple of years ago when people were saying that these things were quote unquote uninvestable on TV, and I was buying them. So, similar with semiconductor stocks, right? They were definitely out of favor in the summer, and I was interested in buying more. Microsoft, definitely out of favor 6 months ago, before ChatGPT got released on the world. and we liked it for a whole lot of host of reasons, and ChatGPT was just the icing on the cake. At the same time, people seem to have caught on Oracle, and that's great, good for Oracle, but we were sellers, and I liked it at 50. At 80, I think it's a little stretched right now, and it's really an assessment of their cash flow. It's not an assessment of whether the stock's going up or down.
So it's not for everybody. It's for people who are comfortable with sort of a contrarian mindset, and it can have exaggerated, for good or bad, performance at times because it is a more concentrated portfolio.
Luckily, it's mostly for good, but
yeah.
I would say that's a good way to characterize it. More contrarian.
So with that in mind, I did want to remind everyone we have the upcoming preparing for your retirement program we have. This is going to actually be offered in person. We will try to record it as a webinar if we're able to, but we have got some great guests lined up to talk about Medicare and Social Security. So for people who are approaching retirement, maybe not quite yet 65, this is going to be probably a very helpful program to understand how some of these big parts of a retirement plan work. And so whether it's Medicare, we've got Susan Flanagan from Blue Cross Blue Shield to elaborate on the conceptually how Medicare works. And then Marcia Mantell, who will be with us on the radio show on Saturday for live calls if anybody wants to call in. But she will be talking about Social Security and some of the strategies and common issues people run into when it comes to that. And of course, we will offer just the idea of, hey, doing your financial planning is really important as you approach some of these decisions. So join us on June 6th from 9 to 11, or if you would like to send anyone or let them know, please share the information, and we'll be happy to give information about that. You can give us a call at the office, 508-771-8900. Not seeing any questions at this time. Let me just check that again. We do not have any current questions. So Brian, let me just ask you quickly to reiterate sort of the big picture takeaways. A recession, should it come, kind of expected, though not, showing its signs imminently at any, it's not here yet, but coming maybe. Doesn't necessarily equate to disruptions in the stock market, and doesn't necessarily mean people should be feeling anxiety. Fair enough?
What we've seen is as the economy's gotten more stressed, it's brought inflation down. Inflation has come down a lot. It was at 9% in June. Right now, it's estimated, that the headline number is 5%. It could be estimated to be below 3% if you take into account real-time rent changes. That has led interest rates to come down or stagnate, which has buoyed stocks. So even though that we're having, a deteriorating economy, which is still strong, but trending negative, it has been actually good for stocks as interest rates have come down. On the bond side of things, we're getting some great opportunities on the short-term part of the curve, which takes very minimal interest rate risk. So we can get paid a lot without taking much risk. So that's a great thing. So, over the last 6 months or so, 6 to 9 months, what we've seen is a stock market recovery from the low. We've seen a bond market recovery that gives us good reason to be optimistic. So there's a lot of negative pessimism out there, but the reality is that lately things have been pretty good. We also think the stock market going forward is not too expensive. We think there's still some opportunity, as there usually is in the stock market. And we expect further opportunity in the bond market as we again, finally reiterated as some great conservative options with short-term interest rates where they are.
Excellent. Well, I think that's a good point for us to conclude. Thank you all for being with us. We hope that the content you've seen has helped you make sense of the environment we're in And if you have any questions, if there's anything specific to your own situation you'd like to discuss with us, please do reach out. You can connect with us simply by calling 508-771-8900. If it's easier, toll free, 866-771-8901. Alternatively, reach out to us through our website, amrfinancial.com. And we will continue to provide these updates. Hopefully they're helpful to you. And if you need to schedule a meeting, please reach out. Brian, thanks for everything. And I think we'll wrap it up. Thanks, everybody.
Bye.